Hi everybody, welcome back to our discussion of Chapter 11. In our previous video, we discussed issues regarding the issuance of stock. In this video, we'll discuss payment of cash dividends. As always, I strongly recommend that you download and print the PDF version of this worksheet or download the Excel workbook so you can follow along with the video and practice writing journal entries in connection with the payment of cash dividends. Cash dividends are discussed in your textbook on pages 422 and 423. There is no legal requirement for a corporation to pay dividends. The decision to pay dividends is made by the board of directors based on factors such as how profitable has the company been this year and in prior years, what is the amount of accumulated earnings throughout the life of the company, whether the company would be better served using the cash it has for the company's growth or to meet emergencies or to pay off debt, etc. Dividend payment involves three important dates. The date of declaration is the date the directors vote to pay the cash dividend. A legal liability to stockholders is created on that date, and a journal entry is required to record the liability. The date of record is the future date specified by the directors for identifying those stockholders listed in the corporation's records who will receive dividends. No journal entry is required on the date of record. The date of payment is the date when the corporation actually makes the payment. It follows the date of record by enough time to allow the corporation to arrange checks, money transfers, or other means to pay dividends. Example: on January 9th, the board of directors declared a $1 per share cash dividend on common stock. At that date, there were 8,000 common shares issued and outstanding. Calculate the amount of cash dividend to be paid. 8,000 shares of common stock were issued and outstanding as of the date of declaration. So 8,000 shares at $1 per share equals $8,000. Now write the journal entry required to record the declaration. Debit retained earnings for $8,000 and credit common dividends payable for $8,000. I'd like to talk just a little bit about why we're debiting retained earnings. In chapters 1, 2, and 3, when we recorded journal entries for the payment of dividends, we debited an equity account called dividends. So why are we not debiting the dividends account here? And the reason is that when we went through the closing process, the balance in dividends was closed to retained earnings. Dividends reduces retained earnings. So we're just skipping the dividend step and going directly to a reduction of retained earnings for the payment of dividends. So debit the retained earnings account when dividends are paid in or declared in Chapter 11. On February 20th, the dividend was paid. Write the journal entry to record the payment of the dividend. Debit common dividends payable, $8,000, to zero out this liability account, and credit cash, $8,000. Retained earnings is an equity account with a normal credit balance. If retained earnings is a deficit, it will have a debit balance. And a retained earnings deficit means that the company does not have any accumulated earnings This usually happens when the company has been accumulating net losses instead of net profits. Most states prohibit a corporation from paying dividends unless the company has positive retained earnings. Well, that's all for this video. When we come back in the next video, we'll talk about issuing preferred stock and payment of dividends where there are preferred stockholders and common stockholders. See you next time.